Hi, I'm Dean Barber, founder and CEO of Barber Financial Group. Thanks for joining me for the monthly economic update. It is mid-October right now, and I'm going to share with you today some really interesting things that have gone on in the interest rate environment. We've talked about that a lot over the last several months. We've seen a change to the yield curve. We're also going to talk about what the markets are doing. We're going to talk a little about earnings, and we're going to talk about the International Monetary Fund and their outlook for the global economy over the next 12 to 18 months. All right, let's get started. I want to start with the stock market, and I've got a chart here that's showing the stock market over the last 3 months. And again, we're mid-October, so we're not month by month here, but you can see here that if you fell asleep 3 months ago and you woke up today, you would think, well, nothing has really happened, but there has been some volatility. It's not been nearly as great as what we've seen over the past 18 months or so. Some volatility did creep back in. We've got a lot of market trading based on news, and a lot of that news is based on what's going on in China and the trade talks. And so we want to break it down into more of a fundamental piece. And look, the markets have been crazy. They're going to be crazy. The stock market's going to continue to react to this news until we get either a favorable or an unfavorable outcome on the China trade policies. So if we look at earnings, when we entered into the fourth quarter of this year and companies are announcing their third quarter results, the estimate was that the companies in the S&P 500 on average would come in somewhere between 4 and 5% lower than what they were during the same quarter a year ago. Early in earnings season reporting right now, we're actually seeing some pretty good results. We're seeing some companies that are beating estimates. We're seeing the markets react favorably to that. And so we'll see if that continues, that trend continues, and that's going to continue to pick up steam over the next couple of weeks. So from a fundamental standpoint, companies are actually doing a little bit better on earnings than what they had anticipated they would do. It's not that they're beating the earnings that they had a year ago in the same quarter, but they're beating what the estimates were, so they're not as negative as what they thought they would be. So markets seem to be more fairly valued at this point in time, but the IMF, the International Monetary Fund, came out with a report here just in the last couple of days where they say that the chance of a global recession is high over the next 12 to 18 months. And the one thing about recessions is they don't tell us on a calendar when those things are going to come. We don't know when that recession is going to come. We've been talking about one of the indicators that we believe has been a very accurate predictor of recessions over the last several recessions that have come, and that is the inversion of the yield curve. And so I want to spend some time talking about that inverted yield curve here. So let me go to this chart here. And this chart is going to show you all the way back from 1980 here, all the way up to our current day in 2019. So if we see the areas here where we get recessions start to happen, or inversions of the yield curve start to happen here, back in 2005 and 6, again back here in the early part of 2000, the late 90s, and then back in here in 1990, those all led to recessions as noted by these shaded areas here. But what's interesting is that inverted yield curve never stayed inverted for very long. And in fact, it wasn't inverted when the recession actually happened. You actually saw in all of these instances, the yield curve comes back to a more normal yield curve before the recession ever happens. And so that might lead people to believe, okay, the inversion of the yield curve happened. Now we're back to a more normal yield curve, so everything's okay. Well, let's look at where we are today compared to October of last year. So this is the yields on your 1 month, 3 month, 1 year, 2 year, etc., and the 10-year. And if you'll remember, a month ago when we were looking at this, the 10-year yield was actually lower than the 1 month, the 3 year, and the 1 year yield. And this is a year ago right here. So the deal is that we've seen this yield curve go from being inverted to now we've got the 10-year treasury yielding higher than that 1 month, the 3 month, the 1 year, and the 2 year treasuries. And so many people might say, well, okay, that's it. there's no chance of recession now because that yield curve is no longer inverted. And one thing you have to keep in mind is just because that yield curve goes back to a more normal yield curve, even though I don't think this is normal, it's kind of flat, but they think that might be the sign that the recession fears have abated, or the possibility of a recession is no longer present. To give you a little bit better look at this, I want to look at the 10 to 2-year Treasury yield spread. This is going back in 2005 and into late 2005. As you'll notice here, the yield curve inverted for the very first time. And then we roll into 2007, and you had the yield curve inverted here. It came back out of the inversion, inverted again here in May, and then came all the way back up, and we had a nice normal yield curve. But look at this, the recession started right here when the yield curve was normal. So an inverted yield curve doesn't mean that the recession is today. What it means is that the possibility of a recession is out there. So we are ever vigilant in looking at what's going on with the yield curve and what's that telling us. And to bring that into focus today, here we were back in January of 2019. We had yields about maybe 15, 16 basis points on the 10-year higher than the 2-year. We did the inversion here, and now we've come back up to where we're not inverted anymore. Does this mean that this little blip of the 2 to 10-year inversion here means that we don't really have the chance of recession? This was just kind of a head fake? We don't know. There's nobody that puts recessions on a calendar. What we do know is that in a marketplace like we have, all expansions are followed by contractions of some sort. So we still believe that there is a chance of a mild recession occurring sometime in the next 12 to 18 months. We also think that we got to look at the markets and say, gosh, in election years, we typically have pretty strong markets. They're never straight up. There's still some volatility that's out there. The one thing that's still driving the markets crazy is this news-driven environment, the tweets from President Trump, the negative news coming out from China. All kinds of things are going to go out there. They're going to continue to drive the markets crazy. But until we see the really more clear signs that, hey, things are really falling apart, we're going to kind of maintain the allocations that we have in your portfolios today, and we don't really see any big changes coming here in the next 30 days. I do plan to visit with you again sometime first or second week in November to give you our thoughts on what's going on there. And as always, here at Barber Financial Group, all your advisors are here to talk to you, to help you understand what we're seeing, what we're thinking, how your portfolio is constructed, and more importantly, how that fits into your overall retirement plan. So thank you very much for joining me here for a few minutes for our monthly economic update. I'm Dean Barber, and I'll talk to you next month.